All right. Well, hello, everybody, and welcome to tonight's webinar. See a bunch of you jumping on. Here's what I want you to do as we start off the evening. If you are jumping on and you're joining the webinar, so good to be with you. Make sure you go into the chat, and you should see it right down there at the bottom of your screen. Go into the chat and tell us that you're here. Tell us hello and tell us where you are joining us from. Because we'd love to spotlight you guys and say hi. Tonight's gonna be a lot of fun. This is something. Oh, by the way, if you don't know who I am, my name is Kevin Clayson. I'm one of the co-founders of DFY Real Estate. And if you listen to our podcast, Replace Your Income, I'm the obnoxious voice that you hear on the podcast, as opposed to Steve, who's the stately gentleman who always sounds awesome. But excited to be with you guys. And this is the first of what I hope will be a series of these webinars. We get questions all the time on what's happening in the market. And is it a good time to buy? What's going on? Where should we be looking? And we have so much information that we're getting constantly, perpetually from our amazing teams out in the field, and just from the interaction that we're having on a regular basis, that we thought, what if we could start to do a monthly webinar where we are just hopping on and we're answering your questions and we're talking a little bit about everything that's going on and helping you see what's happening in the market, what trends we're seeing, and just throw some analysis your way. And so I want to thank everybody for joining us. If you're just jumping on, go into the chat and say hi and let us know where you're joining us from. We'd love to say hi back to you. And the chat is going to be where, if you have questions throughout the night, make sure you go into that chat, ask the question, and you could either send the message directly to me or you could send it to everybody, whatever you want to do, right from the chat. And I'm going to be collecting those questions. And at the conclusion of the webinar tonight, after we kind of are able to share some content with you, we're going to go through and answer all of your questions. So we want to be able to hang out and share as much as we can. This webinar is being recorded, and so we will share this in an email so that everybody can go back and watch the replay and find out the information that you need. We are likely going to oh good, we've got a couple questions already. Oh, chat is not turned on. Well, better fix that. Hold on, let me see. You know what, if chat is not working, guys, I'm not sure why that's not working. It might just be a setting. You can go here. Why don't you just go here in questions and answers and go right into the Q&A. It looks like that's working. I see John and I see James in Q&A. So feel free to go into Q&A and drop your question in there. And while our first presenter is presenting, I'll go in and I'll see if I can figure out what's going on with the chat. I apologize that that's not been enabled. I don't know. Must have something messed up in the settings. Anyway, thank you guys so much for joining us. Feel free to go into that Q&A and drop any questions. We'll answer them throughout the night. Let me give you a little idea of what the night's going to be like and who we're going to be hearing from and what the flow is going to be like. So we're going to start with our amazing, you guys know Nate probably really well. Nate's our Vice President of Client Fulfillment. He's been many of you had Nate as an account executive. He's always got his thumb on kind of the pulse of the market and what's going on. And he's collected a ton of information, really good research and data that he's going to be just giving you a high level on. Hey, Craig from Wisconsin. I had a good talk with Craig recently. It's good to see you, my friend. And Steve is here. Thanks for joining us, Steve. We got James and John and Adam. Good to see you guys. Thank you so much for popping on. And it looks like Steve says that maybe the chat's working for everyone. So you guys can, if the chat doesn't work, Q&A works. Either way is just fine. And Jim is watching from Federal Way, Washington. Awesome. Anxious to hear what's up. Good. We're going to share it with you. So the way the night's going to go is we're going to first bring Nate on. Nate's going to talk a little bit about kind of what we're seeing high level in the market, everything from migration in and out of certain markets that we're in to just what we're seeing economy-wise and market-wise. Once Nate concludes his remarks, we are going to invite our Florida portfolio manager, Ryan Heinricher, on. Many of you, if you own property in Florida, you probably know Ryan, or you've heard him on the podcast, or you've heard him before. Ryan is so amazing. He knows all of the things. I'm telling you, I do not know if there's a man on planet Earth that knows more about the Florida market than Ryan. You're going to love to hear from him. Man, it's crazy. Florida has been so strong of a market for so long, and it does not look like that is going to be that's going to be tailing off anytime soon. It's really exceptional. So Ryan's going to come on and share all kinds of great information about our spotlight market for this month, which is the Central Florida market. Once Ryan's done, Steve and I are going to come on. We're going to talk a little bit about some of the announcements that we've made lately. Many of you maybe saw kind of what's going on with Specialized Property Management, our new preferred property management partner, to kind of make Done For You even more done for youer, which we said on the podcast, which I thought was funny. I don't know if Steve thought it was funny. I thought it was funny, but really just trying to fully integrate property management. We love our existing property managers that we worked with. They're incredible. But many of you have been asking for a solution for a long time. And so we're going to come on and we'll talk a little bit about that at the conclusion of the night. So if you're just joining us, thank you for joining us. It's good to have you here. I'm going to work on getting the chat up and working. If the chat doesn't work, you can go to the question and answers and feel free. We got Greg from Gilbert. Hello. We've got Randy letting us know the chat is disabled. Okay, but thank you, Randy from Boise. And Brandon is here with a great question already. Thanks, Brandon. Good to hear from you again, my friend. So we're going to get things started. I'm going to get off the screen. I'm gonna go ahead and I'm going to spotlight. I'm going to get Nate pulled up here. Here, I'm just going to, if you want to start your video, Nate, that would be awesome, and unmute, and then we'll just bring Nate on and we'll get things moving. All right. So Nate's going to talk just a little bit about the market and kind of what's going on. Let me remove my pin, and there we go. Just got everybody there. I am going to get Nate on video here. If he can get on video. Oh, there he is. Awesome. Cool. And then if you want to unmute, awesome. Nate, good to see you, my friend. I'm going to change the view of what this is looking like real quick. And we're gonna get going. So Nate, it's good to have you. As you guys know, Nate knows a lot of things, and Nate has been with us for a long time. Nate, how long have you worked with Done For You Real Estate? I mean, is it 12 years? So
12 years in April. Yeah.
That's awesome. That's amazing. Well, it's good to be with you, my friend. I know you've got some great information. So I'm going to go ahead and turn the time over to you, Nate. After Nate, we'll go to Ryan, and then Steve and I will come on to kind of conclude the evening. So Nate, over to you. I'm gonna pin you and spotlight you for everybody. Okay.
All right. Sounds good. Hey, thanks, Kevin. I'm excited to be here. Almost 12 years with Done For You Real Estate. I've worked with investors of all sorts for a lot of years, actually. And so I really love looking ahead. And in my experience too, is that clients and investors love to try and predict and to forecast and to look into a crystal ball and say, hey, what's coming down the pike? I'm the same way. When you start looking at a lot of the information, the data, historical trends and things like that, it kind of helps you to start looking ahead and seeing what possibly could be coming. And so, you know, we're going to dive into a little bit. I'm going to go just really high level. There's a lot of things that we could actually cover. Really excited to have Ryan on the phone or on our Zoom call as well. He is so adept and keeps his thumb on the pulse of the market down in Orlando. It's so fun listening to him. And so we won't spend too much time on the high level stuff, but dive into the nitty gritty with Ryan. I'm going to share my screen here real quick, and we'll get started on my slideshow here. All right. I hope everybody can see that. So 2003 and looking ahead. So looking ahead, you know, 2023, we're coming into an economy. It's being pulled in a lot of different directions. We had such some, you know, killer years in 2021 and 2022 when it pertains to real estate. Q4 of last year, we started to see higher interest rates. You know, things started to slow down in the economy with real estate as well. And so some of the things that we're seeing, obviously, are inflation. We have higher mortgage rates. We still face and look at population growth, migration patterns within the United States, and especially in key markets, job growth, and then inventory is still a factor as well. And so we'll dive into, some of these things here real quick. It's interesting to see, though, how much influence, the media and what's happening in the markets with, high interest rates and so forth. And so we see a lot of people get fearful and they start to freeze up. And so, when it comes to real estate winners, we always say, like, investors who have the best information and a good strategy, they have the highest chances of winning, especially at real estate. So Done For You Real Estate, we have a very strategic model, an investment model that we focus on. Bottom line, it just works. It's not short term. It's more of a 5 to 10 year hold. We focus on key properties, Class B property, middle class property, where there's always the highest demand in any given moment in the market cycle of people looking to buy, sell, or rent those types of properties. And so we do consider this a longer term investment. Ed Milet did a podcast, he says fear comes from the unknown. And so a lot of clients, they get, shuffled around by what they're hearing in the news and things like that. And rightly so. With the higher interest rates, we got higher, mortgage payments. It impacts cash flows, things like that. So very much, things to be looking at. But we love to study historics, like, hey, what historically has real estate done in periods of high inflation, high interest rates, things like that, recessions. And so that's really interesting to see, because we always see real estate hold its breath for just a short time, but then we always see things, move up. And that's just from historical, past market cycles, basically. So knowing the cycles, tapering and understanding the media's influence, and then looking at patterns, basically. So let's dive into inflation real quick and talk about that real briefly. So we have the Federal Reserve, our highest inflation rates were into the 9s, basically. So the Federal Reserve starts to come in aggressively at, raising interest rates to help curb spending and to lower that inflation rate. And so we're actually seeing that take effect and have impact. And so the CPI, Consumer Price Index, came out a few weeks ago, and it's coming down. And so the rolling 12-month average as of a couple of weeks ago, we were at 6.5. Like I said, we were in the 9s before that. And so we're seeing the desired effects of the aggressive rate increases by the Federal Reserve, basically. Last month, if you just look at, that's a rolling 12-month average. If you just look at last month, we were at 0.2 on the inflation scale. If you took that and averaged that over a 12-month or 12 months, it would be approximately 2.4, which is really where the Fed is targeting to keep or have inflation, basically. So just in the recent last 3 to 4 weeks, that's where inflation is at. So the question is, will the Federal Reserve continue to raise rates? The answer is most likely they will. However, they probably won't be as aggressive as they have been in the past. And so speculation right now leans towards the Fed maybe increasing the rates about a quarter point. And I think they're actually going to meet here end of January, first part of February, actually. And so we're seeing inflation be tamed, within the economy, which is good. The Fed will probably overdo it, so to speak, when it comes to rate increases and correcting that. And then they'll probably start to ease up on rates, basically. Probably, it's hard to say, a year or two down the road, depending on how things go. If we look at mortgage rates, we don't have Dustin Raines. Dustin's our senior loan officer here with Strategic Lending. And so rates obviously have almost doubled from where they were. We saw mortgage rates up into the mid 7s, actually. We've seen them settle down, and we've had clients been locking on a 25% down 30-year fixed for a non-owner occupied property between about 6 3/8 and 6.5 or so. And so rates have settled. It's interesting to see, though, when the Fed is announcing and indicating that rates are going to increase, mortgage rates usually adjust prior to their meeting and making their announcement. And so we typically have seen that with the last rate increases and announcements from the Federal Reserve, basically. So hopefully, as the Fed meets in the next week or two, that we're going to see mortgage rates continue to settle out where they're at, basically. One last note too about mortgage rates. With our clients and them purchasing properties, investment properties with the 25% down on a fixed rate, a lot of them will work with Dustin and his team to look at a buy down option. So you can actually pay to buy down that interest rate. And so they're really good about sitting down with a client and looking at what that takes, how much it will cost, how much it would lower a payment, what a break even would be, or how much time it would take to recoup that cost. And so there's some options that you can do as an investor with rates to help offset higher payments, higher rates, improve cash flows on a property and so forth. So, all right. Housing inventory. So when we look at what's happening with home prices and what's kind of brewing in the market for the upcoming year, we always look at inventory. Inventory has been an issue since about 2008, since the market crashed, basically. And so this is from the National Association of Realtors, basically. So if we look at January of last year, we had about 1.8 months of inventory on the market. Those are homes on the market being sold, basically. So we see this inventory amount of time on the market increasing. Last month or last couple months, we've seen about 3.4 months of inventory on the market. And so it's increasing, which is good. What's happening in the market is good. I think for home prices, it's, kind of keeping them in check a little bit. We don't see as much competition. To put this in context, and Ryan might speak a little bit about this, though, is that I would say in normal markets, we would typically see double the amount of inventory than what we're seeing right now, or double the amount of time on, of inventory, basically, more like 6 months of inventory available, basically. So we're still short on inventory. It's kind of sleeping right now, in a sense. This is from a Forbes article just this month. It says low housing inventory has been a challenge since the 2008 housing crash. We still haven't fully recovered. It's interesting when you dive into inventory, you have a few different segments of the market. So you have aging homeowners, which is kind of interesting, actually. So we have seniors and baby boomers. Typically, as they get older, and at least historically, they would start selling their homes, basically. But says, why are seniors holding onto their homes? We see a few different factors. There's higher levels of education. There's better healthcare. They don't have to travel to the doctor. They can do a lot of things virtually. They have longer lifespans, different things like that. So we're seeing seniors not sell. Baby boomers are expected to stay in their homes at a higher rate and thus contribute to even more to the number of houses held off of the market. And so we see some of these seniors and baby boomers, not selling and hanging on to their homes. I was talking to Ryan. We see a lot of clients that purchased properties, in the last couple of years at very low rates. We saw a lot of refinances as well. Clients either doing a cash out refinance or just what we call a rate and term. So they're redoing a mortgage and then taking advantage of those lower rates. And so it's hard to kind of sell or let go of those properties at those lower rates. And so we have people hanging on to their properties because of those low rates, basically. Millennials, we talk about millennials in the past. It's still a factor, and it's quite interesting. So, there's an estimated 72 million millennials as far as that generation is concerned. They're all at peak buying age. It's the largest population since the baby boomer generation. This is a quote from Freddie Mac, basically the government mortgage lender. It says 80-somethings, Al and Rose, have no desire to leave their home of decades. Meanwhile, 30-somethings, Alex and Rita, can't wait to buy their first home, but they may have to wait longer and pay more than they'd like, as long as longtime homeowners stay in their markets and keep them off the market. And so really we're talking about supply and demand here, basic economics. And so the inventory is still at a shortage, basically, there. When we look into our markets, there's a few key indicators that we're always looking at. Job growth. Are there jobs to be had for those that want them, basically, and population growth. So people will move for jobs, basically, and so we see that. And so when we look at migration rates and what's happening, it was really fascinating. Before COVID, we would see a lot of migration happening. I'll use Florida since we're highlighting the Orlando market today. So we'd see a lot of, and Ryan will talk to this as well, but we'd see a lot of East Coasters, Northeast Coasters moving down into, the Carolinas to Florida, basically, things like that. They're bailing out of the big markets, the high taxes, the high house prices, things like that. COVID increased that migration pattern even more. And so we were kind of thinking that migration might slow down a little bit after COVID, but it's really maintained and kept pretty steady. And so looking at, it's called the Joint Center for Housing Studies with Harvard University. They talk about this and they study this as domestic migration, which is more people moving into the state than out, and not including immigration, basically. This is their map, basically. This is published as of August of 2022, but capturing the migration patterns in or out of each state, basically, during the pandemic. And so the dark blue states have the highest number of migration, people moving into the state, just followed by the light blue states, and then the yellow and the orange, we're seeing negative population growth. And so if we're ever in a market or have our clients in the market and we start to see slowing or negative population growth, it's a big red flag for us to keep an eye out for. And so real quick, as far as investors are concerned and looking at 2023, whether to buy, not to buy, knowing the numbers, when you really take a look at the numbers and the market trends, even at higher rates, these properties still work out. I always tease our clients and say, hey, we're vanilla real estate, but vanilla tastes great and it works out great. And so when you really look at conservative projections with the types of properties which we identify and help our clients purchase, long-term effect is they really put our clients in a good position. You have good cash flows over time, good appreciation. You talk about the tax benefits of depreciation. You have principal pay down on the mortgage. I mean, a 5 to 7 to 10 year hold on this type of property that we help our clients with really plays out very nicely. And so when we look at when we eliminate the unknown, we look at the factors, the trends, the historics. It really helps our clients, and Done For You help them make informed investment decisions. Before we jump over to Ryan, I wanted to highlight, let's see, I hope you can see that all right there. We've always had a pro forma. We've used our pro forma for 10 plus years, basically, which is numbers. It's the tool that we present to you to look at the numbers. We've redone that recently. A lot of our clients may not be aware of this unless you're currently shopping for a property. We've redone the pro forma. We've actually called it a property analysis, or a PA, and it extrapolates and forecasts out a property and the returns, the cash flows, the appreciation, even tax benefits up to a 10-year period, basically. And so it's a little bit more succinct. And I think that we fine-tuned, the property analysis to help give you more data to help you make just a more of an informed decision. And so we even, look at a few different projection scenarios. So nationally and historically, what has appreciation done? What's the typical likely scenario for a DFY client and a property that they purchase? And then what's, possible? What have we typically seen over time? So we base our projections and helping you look at a property based off of a likely scenario, but you can kind of extrapolate like, hey, worst case, if we just hit what we nationally have hit over the last 100 years, how does that play out? And they still play out very, very nicely as far as numbers and what you'd walk away with. We have a lot of the same information on there from our previous pro forma. The second page of this is where we break this down from years 1 through 10. We talk about gross rents, taxes, a lot of this. We focus on your net monthly cash flow like we've always done, but we also really focus on what we have called the combined monthly cash flow. And so a lot of our investors, they don't really look at, hey, what's the tenant paying as far as the mortgage payment? How much is being paid down as far as that principal? So what's your average principal reduction on a monthly basis year over year? Also depreciation, this depreciation is a pretty powerful thing. It's actual dollars that you do not pay the IRS every year that you get to save because of owning an investment property. And so we basically take some scenarios and saying, hey, what would be an average of what you would save each month because of depreciation with that property? And so those are all dollars that are actually you keep in your pocket, for a piece of real estate. And then we project out, obviously, appreciation, expenses, what it would take to sell, what you would walk away with over time. So some very good detailed data to help you look ahead, analyze a property really well, and just really make an informed investment decision. So we're really proud of this. We spent a lot of months, reviewing this, making a lot of changes, a lot of research. And so we've been really pleased with this and what it's turned into. So, so some quick highlights. That's what we focused on as far as 2023 in general. Coming back to Ryan, we've been working with Ryan Heinricher down in the Orlando market. He's been with us for approximately 13 years. I mean, we just had this long-standing relationship. I love talking to Ryan about the market down there. He has such great insights. And so we're going to turn the time over to have him go and deep dive into some of the market trends and economics of the Central Florida market, Florida in general, Orlando, and really excited to have Ryan on it. So Ryan.
Hey, thanks, Nate. I appreciate it. Glad to be here, everybody. Coming here from Florida. It's a little later in the evening, but happy to be here. And I think to sum it up earlier, I was asked what the temperature was, and it was 75 degrees today, no wind, beautiful sunny skies. And that's the primary reason people are coming to Florida. It's something that's hasn't changed in decades and probably isn't going to change. And sometimes it's Groundhog Day for us, and it's just another sunny day. But to people living in the north, it's a special thing. And I grew up in South Dakota. I grew up on a farm in South Dakota, so I've had my share of cold weather. I've been in Florida for I guess 12 years now, and I spent some time in New York City before that, and Tennessee when I was in the banking industry. So I've been around quite a bit. I call Florida home now. Really glad to be here with you all. And Nate, tough act to follow as always. Appreciate the introduction. One of the things Nate said about vanilla real estate resonates with me. Vanilla is my favorite flavor of ice cream, and sometimes the best things in life are the simplest things. And some of you might have heard of the Lindy method of things, and that is, if something has been around a long time, the chances of it continuing to be around are much higher than something that is new. And so we look at the types of properties that Done For You presents to clients. And when I interacted with Done For You, we were in the business of sourcing properties like that. And so it really was kind of a perfect match, because we view the typical home, the typical median price home that Nate was calling vanilla, as the type of property that casts the widest net for the most number of people in the United States. It's the property that is most desired by tenants and homeowners, and again, just really captures the most people. So when I heard their philosophy, and that was our philosophy, that just really resonated with me. And here we are 13 years later. We've sold about 2,000 homes in the Florida market and transacted over $500 million of real estate. And what we do continues to work. And of course, markets have ups and downs, but long term, I think the market that we're in here in Florida is I'm partial. It's the best market in my opinion. But I'd like to dive into, I'm going to show you guys a few slides tonight as well. See if I can get this to share. All right, great. So Florida is a real popular state, and I often get the, why Florida, and it's pretty common that there are markets that have maybe higher cash flow or a better cash on cash return. And so I often get the, hey, I'm looking at all these different markets, and Florida, just the cash flow is a little low. And so really, why would I go to Florida? Why would I prioritize Florida that might have lower cash flow? And really right now, why now? Why in this market where Nate is talking about the economy really transitioning to a market of higher interest rates, maybe slightly higher inventories? I mean, there's more risk in the market. So Florida historically has been a place of booms and busts and risk takers. And it's a newer state, and it's a state that in the 60 years ago didn't have air conditioning in most of the state, and it's a new place. And so why Florida? Why now? And so that's what we're going to talk about tonight. And I love kind of sharing some of the data points on Florida. We're going to talk about the Florida story for some of you who don't know it, but I think a lot of you know that people are migrating to Florida. It's just a very high growth state, and and there's a number of drivers for that. But I wanted to share some stats for you. This is a slide I had prepared a few weeks ago using data that was as of May of 2022, and it was talking about from January through May of 2022, 21,500 New Yorkers got new Florida driver's licenses. That was a year to date. And then the year over year was 61,000 New Yorkers changing from a New York driver's license to a Florida driver's license. Well, you can't do that unless you can prove residency. So we know that at least nearly 62,000 New Yorkers moved from New York to Florida, and that doesn't count their children. So I think that really resonated with me to see that number is, from the New York Post, startling exodus to Florida accelerating despite New York reopening after the COVID restrictions. And if anybody has seen some of the leaders, in New York talking about, as soon as we reopen, everyone's coming back, it's not the case. People are moving to Florida. They're continuing to leave the state of New York. And then New Jersey had a 9% increase over the prior year, Connecticut a 4%, and then a huge increase of people from California. So when you think about that, that's a lot of humans just saying, I'm moving, I'm becoming a permanent resident of the state of Florida. So I had this slide done, so I left it in here, but then the new data came out, and it really kind of blew my mind. You can see this article, January 19th, more New Yorkers moved to Florida in 2022 than any year in history in staggering exodus. So even though we had some numbers through May, I hadn't seen really an update. And here we are looking at the full year update, nearly 64,500 New Yorkers, 32,000 New Jersey moves. Oops, I got a little typo there. But for the first time ever, 30,000 people from California transfer their driver's license to a Florida driver's license. Again, we are not talking about the children. We are just talking about the adults that are driving cars and changing the driver's license. So you're looking at some, big numbers here. Between those three states alone, 130,000 people changing their driver's license. It's a lot of people, and it's a lot of rooftops that are needed for these people to reside in. And thankfully, that's what we all do here, in the Done For You team, is we supply those rooftops. The census data came out very recently, and this is really amazing. Florida, fastest growing state for the first time since 1957. People might say, well, I thought Florida was one of the fastest growing states. Well, Florida's had a number of the fastest growing cities, but what's typical with a fast growing state is it's typically the smaller states with smaller populations that can show a large growth year over year in their population. So for the third largest population, a state of 22 million, to also have the fastest rate of growth is remarkable. And so, you start thinking about that and knowing that you've got about 400,000 to 500,000 people that the state is growing by, and it's a lot of rooftops. It's a lot of pressure on the housing industry. And then this other headline I loved, do 1,000 people really move to Florida every day? Because that's what people have been saying. And according to the census, they believe that number is significantly higher. So you have more than 1,000 people moving to Florida every single day. I mean, we can't build 1,000 houses a day in Florida. So that's pretty wild stuff. And Nate, I don't mean to diss you here, but you said cut out the headlines. Sometimes the headlines work in your favor. Sometimes the media works in your favor. I'm definitely a numbers and a facts type guy. But when you see this type of stuff, and a lot of people are seeing this, and they're saying, well, why am I not moving to Florida? So I think as an investor, you kind of weed out and ignore the headlines, as Nate was suggesting. But I think for the average American out there who's not looking to invest in real estate, they're probably more soaking in the media, and they're getting sick and tired of maybe where they live, or this winter, I hate to say it, it's just a fantastic winter for Florida because everyone's getting record snow and cold weather. And there's a lot of people that are putting up that snow shovel for the last time, and they're saying, I'm never going to do this again. And I think of all the interactions I've had in the 12 years that I've lived in Florida, and a lot of introductions when somebody says, oh, I'm from Michigan or I'm from Pennsylvania. I said, well, why'd you move to Florida? And so many people would say, I decided I never wanted to shovel snow again. And here, we don't shovel snow, we shovel sunshine. And this particular slide, there's a couple headlines here that I absolutely love. You look at the number of high income households moving to Florida. Wealthy Americans are choosing Florida over all other states, and it isn't even close. So Florida, 20,000 high income households moved here. State of Texas was number 2 with 5,000. The number of high income households moving to Florida. So the next 7 states, Florida had the same number of all of those states combined moving to Florida. So wealthy Americans are moving here. You might say, well, we're not supplying homes to wealthy Americans, but that's having a pretty significant effect on our economy. And this down in the bottom here, the Florida average household income is $83,000, but a family moving to Florida is $120,000. So all of this, everything I'm talking about right now is about growth. And I look at, when you're looking at an investment, you're looking at income, you're looking at yield, you're looking at growth. And I tend to believe that most of the people on this call probably have names like Apple, Microsoft, Google in their stock portfolios. And I'm going to guess that most of you have an outweighted investment size in or allocation to tech companies. And why? Well, because they're high growth. You might have a AT&T that's paying a 6 or 7% dividend. And if you're looking dividend to dividend, AT&T looks a lot better than Google, but most of you are probably having a bigger investment in Google because that's going to grow. That investment has a high probability of growing much faster. So I kind of equate Florida to that. You see all the growth in the numbers I'm showing you, and then it's kind of why. So let's get back to the story of Florida and why people are moving here. Why all this growth? No state income tax, for one. There are 7 states in the U.S., and a handful of those are in the Sun Belt. And on the East Coast, there are 2 states in the no income tax East Coast Sun Belt, and it's Tennessee and it's the state of Florida. We're sitting here with no income tax, and we had a record surplus of nearly $22 billion last year. $22 billion. To put some context, California had a $20 billion deficit. So a $40 billion swing for us is fairly significant, and we're doing it without a state income tax. So how are we doing that? Well, there's lots of revenue coming in from all the growth, from new businesses opening up, from real estate taxes, from a lot of other places that the growth is coming, but we're not burdening the general population as far as their income is concerned. So even if you make the same amount of money in any of the no income tax states, you move here, you automatically get a raise. And I lived in New York City before I moved here, and it was an automatic raise. In New York City, you have a state income tax. You also have a city income tax. I mean, there's like an income tax on anything, and it just is nonstop. It's relentless, and they're looking for revenue, so they're always raising taxes. So we have the third lowest debt per capita in the United States. We have reduced our debt by nearly $10 billion since 2011. And as you can see, it says another 13 billion is projected over the next 10 years. So what is the state doing with its money? It's investing in infrastructure, primarily infrastructure, education. Going back to the state, I'm seeing things like your LLC business renewal taxes are getting cut. They're giving money back to the population. So I think one could probably argue that Florida's running very well right now, and that also seems to be accelerating. So when a state isn't burdened by its debt, it can focus on growth and infrastructure, and we have leadership that is doing just that. Other things, jobs. Since 2019, the Florida labor force has grown by over 500,000. That's a lot of new jobs. You can see the top 5 areas for growth over here, and you can see that there's just a lot happening in there. Greater Orlando, which includes a couple of these here on the right: Lakeland, Winter Haven metros, the Villages metros. A third of all the new jobs are coming into the Central Florida market. The Villages, some of you may have heard of it. It's a 55 plus community. We source homes in the commuting distance to the Villages. It was the fastest growing city in the United States by far. The main developer in there is selling 300 homes a month to people that are 55 and older moving in. I would sort of guess that the 55 and older crowd that's retiring to Florida from the Northeast is probably not too interest rate sensitive. They're probably paying cash for most of those homes. The other area, Lakeland, Winter Haven, Polk County, it's part of our Southwest Orlando footprint. We've sold well over 1,000 homes in that area. Some of you might know it as the I-4 corridor. So it's the area in between Orlando and Tampa. So it just so happens that the areas that we're targeting are some of the fastest job creation engines in the state. And nearly 12% of all new businesses formed in the United States were in Florida last year. I mean, that is a mind-boggling number to think that there's, Florida doesn't account for anywhere near 12% of the population, but we're 12% of all the new businesses formed in the US. So pretty remarkable. And the last little note here, in the last 4 years, 1.5 million new businesses have started in Florida. Again, just kind of another crazy number. And then the other reason that Florida's growth story is just kind of, just really continuing to happen here is tourism. You can see what's going on in this chart. It's as if our share of foreign visitors is going parabolic up compared to others. You can see Florida and Texas. Texas a little bit of growth, but Florida's capturing nearly half of all visitors to the United States. That's just, again, just a really crazy number. This is an overhead shot of a construction site in Orlando. This is the new Epic Universe, which is Universal Studios. Currently has Universal Studios, Islands of Adventure, and Volcano Bay. It has 3 parks in Orlando. Some of you have probably visited one or more of those. The new Epic Universe that they are building is going to be larger than those 3 combined. So as you can see, it's an enormous construction site. It's soaking up a large portion of the amusement engineering in the entire world right now. That is happening. So now I'm going to talk about Miami, and you might say, why? Why are you talking about Miami? But Miami is has been the epicenter of Florida's growth for decades. And it's interesting because Miami is becoming, I would just clearly say it's the new New York City. We're seeing humongous relocation of corporations. Florida used to be this place where people would visit and they would, threaten to leave where they were, and they would come halfway back to the Carolinas or just a lot of people wintering, and Florida's clearly a year-round destination now, but a lot of corporations are relocating out of major cities, and they're relocating their headquarters to Miami. What's interesting about that is really taken off to the point that a house now costs $500,000 in Miami. 2-bedroom apartment costs $3,800. And as you can see here, you have the Everglades on the west. And in downtown Miami, you've got about a 15-mile east to west span, and that's it. So Miami has nowhere to go but vertical. There's a little bit of land left here as you kind of head south. It's not great land. There's a lot of wetland, and it's followed north, Fort Lauderdale, Boca, West Palm Beach, and it just gets kind of narrower and narrower. And this is not a significant distance here. You've got about 100-mile metro area, and it's packed with 7 million people, and because there's no land, everything's kind of going vertical, and so you have a large segment of the population that doesn't want to live in some high-rise building. And what's interesting also is Miami's, here it's kind of nicknamed the capital of South America, and there's tons of multinational companies from South America coming in as well. And so it's just becoming this, incredible melting pot of people. And a lot of people come from South America, and they're okay living in that high rise for a while. And then guess what? They want the American dream. And the American dream isn't living in some 30-story building and, the power goes out and you got to go down all the flights. It's having a house with a fence, a yard, a dog, and a couple of kids. And it's really hard to do that in Miami. Very difficult to do that. So what's happening then is all these people are starting in Miami, and a lot of people from New York start in Miami, and they realize that Miami is just kind of a recreation of another major city, and that growth starts to permeate out. And so what we end up seeing is right now, Miami has the nation's highest inflation rate. Well, that sounds fun if you're living there. You get to see 10% inflation while the rest of the country is seeing 7.5 or 8%, and it's housing costs just going up and up and up. When I lived in New York, when I moved to Florida, my friends in New York City had a running joke, and they said, well, now that you're in Florida, you'll be probably having dinner at the Sizzler at 5 p.m. And just sort of laughing that I was now like this old man in some sort of retirement community. And what's funny now is they all live in Miami or somewhere in Florida, and they're griping about their rent. A friend of mine just had a baby. He's in a 2-bedroom apartment. He's paying $6,000 a month. He said the landlord's looking at going to $8,000. You might as well be living in Manhattan. And so a lot of the reason that people move to Florida for a lower cost of living, Miami, they're now realizing that that's not achievable, and they start fanning out into other areas. This is an interesting slide. This is 1 month, or it's about 40 days worth of development announcements in Miami. And so you're going to see a common theme here. You've got about 30 new high rises coming out of the ground. There's one that's duplicated because it talks about them adding a helipad to it. But this is what's going on in Miami. You have just project after project coming out of the ground. You've got super tall buildings. You've got a new Waldorf Astoria that's going to be 100 stories. That's actually under construction. This isn't fantasy land. This is actually happening in Miami right now. So the idea of Miami sort of competing with what we're doing is really not the case. If anything, I'm rooting for this to all go down, because when it does, it's just pricing people out of Miami, and they're having to move up, and they're used to paying more for a home, and that's pushing our prices up on the type of properties that we're presenting to our clients. So I could have gone, deeper and deeper in this, but literally, when you're seeing this, you're seeing all these new buildings being announced. And again, this is a daily occurrence in Miami. So you have a rapidly, growing city that has no room to go anywhere but up. So that leads us to My poor attempt on a Venn diagram here, but the two major cities in Central Florida, you have Tampa and you have Orlando. And what's really amazing is downtown Orlando to downtown Tampa is only 70 miles. And I've got the stars here because where the two metro areas have growth overlap happens to be, and not by accident, but it happens to be the areas that we are presenting homes to clients. So you have two major metropolitan areas with 8 million people that are sort of merging, and they're merging in these areas where we're farming homes. And you look at the median home price of Orlando at $375,000, $410,000 in Tampa. We just saw the last slide that Miami was $515,000. And then we're focusing on the areas where you could commute to either city if you wanted to, and you're paying $275 to $325, call it, right around there. So we've got our kind of Citrus and Marion area, which is up by the Villages, Ocala, Citrus Springs, Crystal River, and then we've got the Southwest Orlando I-4 corridor area. So that's been our focus. We don't focus further north, Jacksonville, the Panhandle area. There's a couple of reasons for that. They're great areas, but I like areas where this time of year I can be outside in a t-shirt and shorts. And unfortunately, you can't do that in the Panhandle and Jacksonville. They have a different climate. So we want to be in those areas where we know the people are coming because the weather is dynamite in the winter. And so that's a driving force that, climate might be changing, but I don't see it really working against us with regards to people moving. And just to give you some context, so downtown Tampa to downtown Orlando, you have 70 miles there. And a lot of you might not know this, but West Palm Beach to the Bahamas, this is a 52-mile, this is a 1 hour in a boat type deal. So when you're kind of looking at these mileages, it's not that unreasonable to say, okay, well, we live in South Florida, we're getting out of there. We're going 3 hours north to Orlando area, and we're going to find cheaper housing. Orlando has over 50% of its inbound migration. It comes from Miami, and our Citrus area, they get over 50% of their growth from Tampa and Orlando. So you're having that type of interaction, and we like being that low cost alternative to the congested metro areas within Florida. Another thing that we do is we just follow master infrastructure. It's not a rocket science type plan. We can look and see that the state is spending, in this instance, the state's spending a couple $100 million to extend a freeway into Citrus County. Well, guess what we were doing? We knew that freeway was coming, so we started buying homes in Citrus County 2 years ago. And we did this in another area, Kissimmee, Point Siena area. We knew the Point Siena Parkway was coming in. We go in there a few years earlier. The state is making the announcement. They are going to spend the money, and the growth is going to follow the master infrastructure. So when we're looking at major investments coming from the state or federal level, we like to follow that growth. And it's public information. Sometimes you have to really dig for it, but the beauty of real estate, as opposed to investing in equities, insider information is illegal. In real estate, insider information is highly encouraged and recommended. So we think we can just continue that plan, and it's worked really well. This is, in particular, is a freeway coming out of Tampa moving north, and that's just opening up corridors of growth all along this. And then you have future growth coming as they continue to expand this. So another reason people are moving up here, what's going to make it easier for people to move up here, we have a high-speed rail, the Bright Line, and that is opening this year from Miami to Orlando. And a lot of you probably have had high-speed rail has been talked about in your state. This is the real deal. It's already open from West Palm Beach to Miami. Last month, 183,000 passengers used it. I've been on the train a number of times from West Palm to Miami. It's a 1 hour ride. It's a phenomenal experience. It's smooth. It's reliable. It's inexpensive, and it brings you right into downtown Miami. So this rail system, they are not. Yesterday or a couple of days ago, there was an announcement. 90% complete. on the rail to Orlando. So it's happening this year. This image below is the rail station being substantially complete in Orlando. So this is all going down, and you'll be able to have a 3-hour trip on a train, as opposed to a 4-hour drive if you're lucky with the traffic. And you'll be able to work and be a real kind of commuter. And then, as you can see, there's a couple of other stations that are planned, and with an eventual expansion to Tampa. So we're on the map with high-speed rail. It's happening, and it's another master infrastructure. It's privately funded. It's not Amtrak. It's not some federal government boondoggle. This is the real thing. And so you see these just incredible investments happening in the state of Florida on infrastructure, and they're prepping for the people to come. This is a slide about the Orlando International Airport. It's now the 7th busiest in the world, up from 31st in 2019. They just opened the $3 billion Terminal C. It's beautiful. I flew out of there. It's all international, and I believe JetBlue as well. So I took a trip last month from here. It's phenomenal. It's going to add 12 million more capacity, and it's got the high-speed rail connects right there as the first station. So you have, again, another 3 billion of infrastructure happening with air travel, and the Orlando airport is really scaling up there. And I like to finish. I'm going to, I've talked a little bit. I'll be happy to take some questions as well, but I wanted to give you guys kind of an overview on why Orlando. I didn't want to get into a lot of charts and graphs tonight, but this is like you're hearing about the hurricanes, and a lot of people have objections and reasons not to invest in Florida. And this is sort of the perception. Is you probably saw this during Hurricane Nicole, Wilbur by the Sea. The homes were collapsing. You can't rebuild, like they lost their land and everything. And that's not what we do. Over here on the right, that's what we do. We focus on homes in good elevations. We don't buy on the coast. We focus on great home quality. We build concrete block homes. We source concrete block homes for our clients. So we try to mitigate hurricanes as much as possible. And because we're in Central Florida and we're further inland, that has a substantial effect on the cost of your homeowner's insurance, which helps your pro forma. And then flood zones, kind of the same thing. Avoid bodies of water, avoid low-lying areas, don't buy near the coast. There were areas in Southwest Florida that were 20, 30 miles from the coast. And when Hurricane Ian hit, and it wasn't the storm surge, it wasn't the wind, it ended up being all the rain, and those rivers backed up and flooded areas, and people ended up with a ton of water. So while being on the water is glamorous if you're going to live in the house or maybe vacation, I think for a long-term investment portfolio, you can really mitigate the risk by just being further inland and being in areas that are high and dry. And then to finish it, the lower cash flow. That's the number one objection that I hear. And I think of just total return and growth potential. So, you're gonna balance your portfolio. A good balanced portfolio is gonna have a mix of growth and income assets. Yeah, sure, you might have a utility stock, you might have some AT&T or Verizon stock in your portfolio, but you also need the growth stocks, and the growth stocks are often what propel the portfolio forward. Maybe there is a little bit more risk, but that's where you're going to get the long-term growth and see that investment really take off. And the number one driver of home price growth, period, is population growth. It is population growth over and over and over. And I think we have most states beat really hands down. And I think we've got a pretty good map for continuing that. And then I actually have to lie. I got to finish with like a really detailed chart. So don't hate me for this, but I like numbers a lot, as Nate knows. People always ask about, where are we going from here, and what's the prediction, and where you at? Do you have a crystal ball? And I don't have that, but I've got this handy 20-year market history of Orlando. And I love looking at this because they update it every single month and they just a rolling 20 years. And so one of the slides Nate presented earlier was be a student of history. And I love history. And I think that note really resonated with me. So when people say, where are we going? The market's soft, or I'm hearing all this doom and gloom on TV, and I want to give you some context. And so as you can see across the top here, we have the month and year, we have interest rates, sales, median home price, average, pending, days on the market, inventory, current inventory, the change over the prior month, and month of supply. So Nate talked about the months of supply being at 3.4.
Hey, Ryan,
I like looking at this. Yeah.
Ryan, we can't see the chart.
Oh, you can't see the chart?
No.
Okay, let me see. Let me see if there's a good way to do that. Let's see. All right, let me try to share screen. How about now?
Good to go. Yeah, thank you.
You can see it now? Okay, thanks. Okay, so just looking at the top here, you can kind of see going across sales, prices, inventory. The inventory and the days on market and the inventory, the change over the prior month and the month supply, those are big numbers in my opinion. And as you look here, I like to look at 2007 and let's just say, well, what was it like right before the market crashed? And here's what's kind of crazy. You have inventory running 26,000 homes and you've got 17 months and then it even hits 27 months over 2 years of inventory. And the inventory peaks out at 26,300 homes. So if you turn the clock back to 2007, the greater Orlando area had 500,000 people less. So I don't know how many homes you need to supply 500,000 people, but it's a lot of homes. So we have 500,000 more people now. Now let's look at right now. All right, so 26,000 homes, remember that number. We have 6,000 homes on the market. And you can see our inventory bottomed out here at a 0.68 month supply of homes. And inventory kind of spiked here the early part of the year as it did everywhere in the nation. But this is what's really, really crazy. What I believe is have believed that this is a lull that we've been in and that the market is going to take off once people adjust to the new interest rate environment. We had a drop of 846 homes. If you look at the month over month change, you have to start going back pretty far. You've got an 813 home drop in 2021, but this is the biggest single month drop of inventory literally in years. And you can see we go from a 3.61 month supply to 2.85. So the inventories just took a big sharp drop, and we could feel there was like a big burst of inventory, big burst of activity, in December over November, and you can see that highlighted here. Year over year, sales are down, which makes sense because there was a frenzy, peak insanity a year ago. But look at December over November, 11% change, and you still see home price growth. It's slower. It's at 3.88. A lot of the nation has dipped a little bit in the red, but we're still showing home price growth, a huge drop in inventory. And so I'm looking at that. And then again, you just sort of start taking the clock back. We have 20,000 less homes on the market now than we did in 2007, 20,000 less homes. And we have 500,000 more people. So that shortage in Nate's slide that I think it was Forbes or somebody was talking about, it's real. It's real. So there's a lull. People are seeing higher interest rates, but all the migration patterns we discussed earlier, those are all intact. The Florida story has not changed. I think it's accelerating, if anything. And I believe that we are going to feel that shortage again this year, especially as some of the home builders kind of pulled back from production, not sure what's going on. And now we're seeing the effects of that. We're seeing a big drop in inventory. We're below a 3-month supply again. So with that, I will turn it back over to you guys. And thank you for your time.
Hey, Ryan, can I ask a quick question?
Of course.
Do you have any insights or data about new construction or housing starts, state of Florida, Central Florida? What's the trend there?
Yeah, so housing starts were tapering down in the second and third quarter last year, but they are rebounding now. And so we're starting to see home starts again. Some builders had too much exposure and just kind of thought the frenzy might continue. So everybody kind of pulled back, but we are seeing housing starts rebounding right now.
Nice. And then maybe just touch on supplies and materials. What's that looking like? Because I know that we were facing a lot of shortage with material supplies, in 2022, 2021. What's that looking like now?
Yeah, some of your biggest issues were windows, and windows were taking 6 months to get a window package from date of order. Trusses were taking almost a year. And so we saw some, remarkable stuff going on with the counties where they were approving permits without engineering of the truss package and just saying, go ahead and start building the house. And when the trusses come, then submit the engineering and they would approve it. So there was some really extenuating stuff that was happening. Most of those have worked themselves out. We're still seeing what I would call late stage issues. And that is issues with things that when your house gets to 90% done, it gets stuck, and it's getting stuck waiting on things like sod. So for example, you have to have sod on a home in order to get a certificate of occupancy in the state of Florida. Where I grew up in South Dakota, it might be the winter. You have no chance of getting grass in the winter. So people move in and they do it in the spring. Here, it's not that way. So you're not allowed to get that certificate of occupancy until you get sod. Well, there's only so many sod farms, and they're not really making sod farms. And so sod has been something that people are fighting over. I see a truck full of sod going down the highway, and I want to hijack it, So that's an issue. And then I would say we're also having issues with some of the homes that are on septic. Some of the septic systems are backed up. It's a specialized, piece of equipment. And then cabinets have really gotten better. The last thing that is still a challenge is getting power. A lot of times you'll have a house that's completely finished, but Duke Energy is so backed up and they can't hire people. They can't find qualified people to work. So you're waiting, with a finished house, and you can't get power to that house. And so it's sometimes we'll hear kind of the grumblings of, you need to finish my house, and we're having to do rate lock extensions and this and that. But no one wants the house to be finished faster than the person who's selling it is what's my thought. And so it's just, a lot of it ends up being out of the control of the home builder, but the supply chain has definitely gotten better, and the turn times have gotten better as well.
Thanks.
Awesome. Great. Ryan, before we let you go, I don't know if you're going to head off to your family or not, but Jason White asked when the corridor is going to be complete.
For the rail?
I think so. I think that's what he was referring to.
Yeah. With any major infrastructure project, it always seems to be kind of bumped. They said first quarter of this year. I'm now hearing June, but they are running test tracks on the train, which is a good sign. And so, that's the infrastructure corridor. And I'm not sure if that means the I-4 corridor. The I-4 corridor already exists.
I would guess the Suncoast Parkway, the SR 5891.
Oh, yeah. Yeah, the Suncoast Parkway into Citrus County, that segment opened in March of last year. It is open. They're now doing another, they're going to be expanding it further, and I believe that's 2025. But the extension that hit Citrus County, that opened in March, and it's got really good numbers on it so far from what I've read.
Awesome. Great. Thank you so much, Ryan. Ryan, are you going to stick around, or are you taking off?
Yeah, I'll stick around in case there's any additional questions, if that works for you guys.
Okay, fantastic. Good. Well, thank you so much, Ryan. Steve and I are just going to take a moment and talk a little bit about kind of some of what some of the announcements that you all have heard. We really appreciate Ryan coming and sharing. Ryan is amazing, such incredible info. Nate, thank you for all the information that you provided too. I hope that everybody's feeling a little bit of a sense of calm. I know you probably hear the podcast or you hear us talking about the fact that, hey, we always feel like now's the right time to buy. I don't know if there's ever been a time in history where we at Done For You Real Estate have said, oh, not a good time to buy. We feel like there's always value in buying. And what you heard tonight hopefully validates that, because we have so many clients that have purchased so much real estate over the years and continue to expand their portfolios across multiple markets. Some of the feedback that we've heard time and time again is it would be really nice if you had a singular property management solution where there was one login, one phone number to call, so on and so forth. And so Steve and I on the podcast this week, if you guys are not subscribed to Replace Your Income, highly recommend that you do that. On the podcast this week, we talked a little bit about it, but we thought we'd do a little recap here. And so Steve, let's maybe talk a little bit about, how this came about, what some of the shifts are, and what's really exciting and what we'll conclude the night with before we take questions is some of the new markets that we're going to be opening as a result of some of the things that have taken place.
Yeah, and I would just like to reiterate just one thing real quick. I really appreciate Ryan and Nate, their insights, the data that they put together. There's a reason why so many people have come to Done For You Real Estate and hired us to help them invest in real estate. And part of the reason is this: when you just go to the general media, whether the market's going well or whether the perception of that is that the market isn't going that well, that's generalized, very broad information. We niche down, right? If you look at what Ryan was sharing with us, like he could get down to the very zip codes, he can get down to the very streets. Buy in this street, don't buy in this street. That's what we're all about. That's why people come to Done For You Real Estate, is because you're getting information, knowledge, and insights that you simply cannot get anywhere else. And so those who have joined us tonight, I'm grateful that you've come and participated. Those who are listening, days or weeks or months later to this webinar, and who will be listening to additional webinars in the future, the benefit of working with organizations like Done For You Real Estate is this very fact that you can come and gather information and make decisions that you otherwise couldn't make. You can be in a market like this where everybody thinks that interest rates are crazy, when in reality, interest rates are actually historically still low. Interest rates work, cash flows work at these interest rates. So when I hear people say, well, interest rates are really high, it's interesting to be able to sit down with individuals and help them understand that, for the types of properties that we buy, for the cash flows that we create, for the investments that we do that we look at from over the course of 5 to 10 years, interest rates are perfect. I'm in the process right now. I just made an offer on a home today. I had an offer accepted yesterday, and my goal is to increase my personal portfolio significantly. My goal for the company this year is to increase its portfolio significantly this year, because truly, actually, in the history of buying properties, in the history of investing in real estate, there have been few better opportunities, in history, to buy real estate than what we're seeing today. We just learned that inventory is actually still very, very short. The smart money, the investor money, the big money, they are buying real estate right now. And if you kind of follow what they do, they're buying because the time is right to be buying. And so I just wanted to kind of point that out and just kind of sync and bring that to a head. And one of the other reasons why, people come and they engage with Done For You Real Estate is because of what we have been striving to do over the last many, many years, which is to simplify real estate investing so that you as individuals, as professionals, you get to concentrate and focus on what it is that you do, while we do most of the heavy lifting, and while we help make experts of you because of the information that we bring to the table, and of the experts that we gather and bring to the table, like Ryan, like Nate, like Mike on this call here, on this webinar here tonight, where we've brought together licensed professionals to whom we then introduce you to, so that you can go through the process. And so one of the things that has become super important, as Kevin just mentioned, is over the years, more and more of you, our clients, own properties in multiple states. And we are done for you real estate. What's interesting is it only takes 30 to 45 days to purchase a home, right? Sometimes it takes longer if you're buying new construction. It can take months because you're just waiting for the new home to get done. But the reality is you're working with our team for about, 30 to 45, maybe 60 days to close on a home. And it's kind of like this sprint to the finish line to get this property. But then post-purchase, you're engaging with property management for the next 5 to 10 years. And if you have properties, if you're getting closer to that 10 property mark, where you're getting closer to that economic independence, and you have multiple properties in multiple states, and you're working with who are excellent property managers, but you're working with 4 or 5 or 6 different personalities, 4 or 5 or 6 different portals, 4 or 5 different ways of doing property management, doing the maintenance, different accounting statements and so on. It can become a bit of a challenge to manage that many property management companies. And so the overwhelming feedback that we have received over the past several years is that, man, if you guys could figure out a single property management solution so that across all the different markets, I could go to one portal, get one statement, talk to one person, have one phone number to call, one philosophy, it would really greatly simplify, and that becomes more done for you, right? So we got the done for you for the first, 30 to 45, 60 days, really figured out really, really well. But then post that, this is a huge, massive step that we have taken in order to simplify the process. And so as over the last little while, as we've engaged with Specialized Property Management, an announcement that we made January 3rd, that they would become our new one property management solution. It is a big deal. Now, on top of that, being able to, have an organization across multiple states like that, we wanted to simplify and enhance the system even more. I can't say enough about the current property management companies, those who we've worked with for years and years and years. They're awesome. And they've done such a great job, and we appreciate all that they have done, will continue to do, because bottom line is many of you love them as much as we do, and you don't necessarily own as many properties as everybody, and chances are you'll probably hang out and stay with them for many, many years to come, and that's fantastic and that's wonderful. However, for those of you that the new solution makes sense, that will be an opportunity that you'll be able to take advantage of. And that's our goal. That's our objective as an organization, is to continually look for ways to simplify the investing process for those of you who are so busy. And so we are super excited to be working with Specialized Property Management. They have really taken things to a whole new level, not just from the standpoint that they're in many, many markets, but from the standpoint that they truly are fully integrating with us to where we can pretty much call them an in-house solution. They are integrating with our processes, with our data collection systems. We are integrating with them. We're syncing up our systems. We are continually doing training. We have a training this week, actually. A number of their people are coming to our offices to further integrate the system such that we can have real-time data on what's going on with your property, such that the game plan reports that we provide are going to be more real-time with more information, more data points, such that we can provide better information so you can make better decisions on what to do with your properties as you move forward. And so that integration, the transparency, the communication, it's pretty exciting to be syncing up so closely with such a phenomenal organization, a group that we've been working with and vetting and working on this project for going on 6+ months now, Kev.
Yeah. And so if anybody wants to kind of hear the story of how this all came to be, go check out Replace Your Income podcast. The episode that dropped this week, we kind of really dive deep. Just to kind of echo what Steve said, I get a chance to interact with a lot of clients as they're coming on board and as they start to own real estate and start to grow their portfolios. And time again, that's been the feedback. We'd love a single property management solution. The other nice thing about this moving forward, just so everybody knows, and one of the things we think is valuable is specialized property management is a flat rate property management monthly flat rate fee. And so that's kind of nice. Won't really matter what your purchase price is or what the monthly rent amount is. It's going to be the same flat fee across all markets, which is just nice. And like Steve said, the technology stack that they've got and have put together so that we can have better data for you than we've ever had. I don't know how many of you watching have had an opportunity to get a game plan review with your account executive. If you don't know, every single year, this is something that we want to be able to do with you in your portfolio. We've got a great research team. We've got a team headed by Mike. It works very closely with the account executives that will pull up lots and lots of information on the market, on your property, run options for you, scenarios, refinance, sales scenarios, whatever the case may be, so that you can always know kind of what time it is with your property and what the next potential options may be. And so that data is going to get even better. Imagine being able to have a dashboard where you can go and kind of see everything that's going on with your portfolio. That's the strides that we're able to make with this incredible new kind of preferred partnership. And so stay tuned. We'll have some more emails that'll be going out on that very soon. That'll be kind of describing more and more of what that's going to look like. Now, one of the other things that's really exciting, Steve, that's amazing is because of this partnership with Specialized Property Management, because they have already been functioning very successfully in multiple markets, it now makes it very easy for us to expand to additional markets this year. And Steve, talk a little bit about the next market that we're going to be expanding into as a result of this relationship.
Yeah, so February 1st, we'll be expanding into the Dallas-Fort Worth area. It's an area that many of our clients have been kind of screaming at us to go check out, to get into, and so on. And so our goal is to bring you, the best possible markets and the best possible opportunities. I've appreciated so much Ryan being on this call tonight and bringing his expertise about Florida. And one of our objectives over the next several months is to spotlight, a different market each month and allow you to compare and understand the different markets so you can make the choice that you feel is best for you and your investing strategies. And it's one of the things that we're looking forward to doing, and the opportunity that we have to expand your knowledge base in terms of what markets are available and what the markets are showing. And so this year we will be opening a number of markets. We'll announce those as we go, and excited to open up the possibilities. We've been in the same markets for many years, Florida, Indiana, Tennessee, Oklahoma, and North Carolina, and to be able to move into multiple other markets this year and in coming years, and to be able to do so as demand warrants, will facilitate that ability for clients to capture opportunities. When things were really peaked, there's literally a lineup of individuals, waiting for properties, even just to see properties. And it was taking, weeks to even see something. And so we're really anticipating, based on what we're seeing in the economy and opportunity, that we'll see increasing demand. And so this is our way of preparing for some of that demand and being able to provide properties to you, in a more timely fashion.
Awesome. Yeah. Thanks, Steve. As we're wrapping up, I'm going to just make another comment and then we're going to get to some questions. Just a couple invitations to everybody. So if you have not had a game plan review, I recommend that you do so right away. Schedule it. Let's take a look. Let's look at the numbers. Let's drill down and look at some research and see kind of what's going on. and see what your next steps could be. And so reach out to your account executive. If you don't know who your account executive is, that's okay. You feel free to reach out to me, Kevin at DFY-realestate.com, or you could reach out to Nate or Mike. It's our first name at DFY-realestate.com. We are here to take care of you. You could go to the website, DFY-realestate.com. There's a chat feature on the website. There's the phone number that's right there. There's so many ways that you can access us and that you should be able to get in touch with us. So if you've not had a game plan review and have not had a chance to take a look at what's going on with your portfolio, I highly recommend you do that as quick as possible. If some of you are in markets where you are coming up on the time when you might be able to make a property management switch, if you've got a property management contract that's concluding, like in Oklahoma or in Florida, and you're looking at wanting to see what Specialized has to offer, reach out to your account executive. Let's jump on a call and let's talk a little bit about that. For those of you that have homes in other markets where Specialized is not functioning yet, stand by. More information will come out as those markets come online. And the other thing that I'd recommend is subscribe to the podcast. If you're not following the Replace Your Income podcast, you're not subscribed to the podcast, that's one way that Steve and I have to really be able to communicate on a regular basis and invite guests on and share stories and share some real-time information of what's going on. The last thing that I wanted to mention before we take some questions is, if you've not registered for the Daily Fastball, if you go to dailyfastball.com, we have inventory such that we can send out deals on a daily basis and say, this one is available for purchase. And if it's something that you're interested in, you can get in touch with us, get in touch with your account executive, and potentially even put it under contract. Now, in order to sign up for the Daily Fastball, you need to enter your name and your phone number. Now, here's the key. Many of you have signed up for the Daily Fastball and you're letting us know you're not getting the text. We're so sorry that you're not getting the text. However, we cannot legally text you unless you reply yes to the text message that we send you. So if you go to dailyfastball.com, you enter your information, you will have a text message that is sent to you that comes from an 844 number. That's our text service. You must reply yes to that message in order to get texts on a daily and regular basis. If you've not replied yes, go scroll back through your text messages, look for that text message, reply yes, and those should be showing up in your inbox. So we are so glad that everybody was here. We thank you for coming. We are going to be recording this and distributing that this tonight, probably tomorrow. I'll probably send it out tomorrow so that you guys can reconsume it. Or for those of you that are watching this recording, we're thankful that you're watching it when you are. And we're so thankful to Ryan for coming on tonight. As you can tell, Florida is an incredible market. Everybody should be owning real estate in Florida and owning multiple properties in Florida. It is truly remarkable. We're so thankful for Nate bringing his expertise. And so as we kind of wrap up, there's a couple questions that are in the chat and in the question and answer. I'm going to ask these and then we'll answer these and then we'll be done for tonight. So the first question that I just want to address, and Nate, I'll have you take this one, or Mike, either one of you. John Morgan asked, can we get the new property analysis for our existing properties?
We can look at that. It gets to be a little bit challenging if you've held that property for quite a few years. And so, but yeah, I would say just reach out to us and let's discuss that. So
just reach out. You can email Nathan at dfy-realestate.com and he can share that information with you. So that's for John. And then we have, real quick, Ryan, Jack and Peggy Brinkerhoff say hello. I don't know if you saw that in the chat. They just wanted to say
hey,
hi.
What's up, Jack and Peggy?
They're awesome. We love you, Jack and Peggy. You guys are great. Let me see if there is, okay. And then we got a couple great questions from Brandon Miller that I'll get to in just a second. Catherine wondered if this data will be sent to our emails. Catherine, we're going to be sending out a replay of this and it will be in your email. If you're wanting the slides or something like that, let us know. I'm sure we could probably provide that information to you. And we had some other good comments in the chat. So here's the other questions that we had. Oh, Mio, hello, Mio. You asked if the recording will be available. Yes, it will. We're so thankful that so many of you joined us from all over the country. Brandon has a couple good questions here. The first question that Brandon had, and maybe Mike, you can take this one. He said, are you able to depreciate your rental properties while also being able to claim a standard deduction on your W-2 job as well?
Yeah, of course, I'm going to say check with your financial professional, cover my back. But yeah, absolutely. You can take a standard deduction off of your other income. Rental property is looked at on a different line, a different section of your tax filing. And depending on what your income is, you also have the opportunity to offset passive losses that you may be experiencing because of depreciation. You should have positive money left over in your bank account most years. Of course, one year more than others, depending on repairs and other messiness side parts of real estate. But those passive losses from depreciation and other involvements can actually help you with your active income. So not only the standard deduction, reducing the amount of income you pay taxes on, but to potentially losses from real estate, paper losses, perhaps. And so check with your accountant. I can talk a little bit more details too if you want to get with me. But yes, you can absolutely do both.
Awesome. And then the other question for Brandon, he said, what can you do to save on taxes once you reach your 25,000 depreciation limit on all of your rental properties?
So there's no limit on the depreciation that you can have from multiple rental properties. What you may be referring to is being an active participation in real estate. So our clients typically will qualify as an active participant in rental real estate investing because they own more than 10% of their property. And because they do play an active role in the management. Of course, our clients want to be very passive in their interaction. Most of them tell us they don't spend more than an hour or so a month managing the manager, so to speak, but they do have a say in what tenant is accepted into that property. They do have a say and a requirement in the contract from the property managers to approve certain repairs over maybe $350. Because you have that level of involvement with your properties, you typically, again, check with your accountant, but you typically would qualify as an active participant. And as an active participant, if your income is below $150,000, you can have some level of write-offs. That's what I was kind of referring to earlier, where passive losses could help reduce your active income, your W-2 income. So a little more details to that one. But yeah, there is not a limit on how much you can depreciate off of your passive income from your multiple properties. It's just how much you can write off of your active income.
Awesome.
Kevin, I have one really quick question.
Yeah, please.
I can see, based on the marketing that you sent out for this particular webinar, about half of our participants tonight are not clients. For those who are prospective clients, those who are just here learning for the first time, looking into DFY, looking into what it is that we have to offer, what steps can they take if they have an interest to learn more and take additional steps?
Yeah, great question. If you are interested in wanting to have a little bit more interaction with us, it all starts with just having a game plan. And so I go to the website, DFY-realestate.com. And on DFY-realestate.com, you'll see that there's an orange button right at the top of the page that allows you you'll click that button and a pop-up will come. You'll be able to enter your information there. Once you enter your information, the next page will allow you to click another button to schedule an appointment. So if you want to schedule an appointment directly on our calendars without having to wait for a phone call or anything like that, go to DFY-realestate.com, enter your information with the first orange button, go to the next page, click the next orange button that says apply now, and you'll be able to go right to a scheduling page where you could schedule an appointment with us. Otherwise, you can also go from DFY-realestate.com, which is just the main page. You could go to the contact us section. And also at the bottom of a lot of the pages, there's a little contact us section. You can enter your information there as well. And then we will reach out to you to give you a call to try to schedule a time where we could spend, spend some healthy minutes with you and help you kind of construct a game plan as you look to the future. I just had somebody else.
And I might invite Brandon and really anybody else who's interested. I'd love your questions. I love what you're thinking. I love all the many ways investors benefit from real estate. Unlike most investments out there, it's not one way or the other. It's multiple ways. And I love helping to make sense of that. So if you'd like to talk more details, Mike at DFY-realestate.com. Send a note and we'll schedule time. We'll keep talking and get a little bit more specific. Love to help make sense of what real estate can do for your big picture, your long-term planning. So loop me in on that anytime.
Yeah. So again, if you just go to DFY-realestate.com, there's a button right at the top says request a call. We'll call you. If you want to go right to the calendar, click the Find Out How button, and then go to the Apply Now button, and you'll be able to get right on our calendar. You can also always chat with us right from the website, whether you want to interact with Mike or Nate or anybody. You could go right to the website. There's a text us little button that's right there on the page. So we try to make it real easy. I would highly recommend, if anybody is still kind of sitting on the fence, not sure if now's the right time to move forward, schedule a call. Let's jump on a call. Let's get you to the right person. Let's do a game plan review for you. Let's get a property analysis in your hands, and let's see if it's time to make some moves. So to kind of recap, make sure you subscribe to the podcast, Replace Your Income. Make sure you sign up for the Daily Fastball at dailyfastball.com. If you'd like to talk to your account executives, feel free to reach out to them directly or go to the website and text or request a call from the website, and we'll get you to the right spot. We are so thankful for all of you. Thank you for coming. Valerie was so nice. Valerie said she's currently a client. Just wanted to say you guys are awesome. Valerie, you're awesome. But we love you guys. We're so thankful for you. We are going to keep this going. So we'll do another monthly market update next month. We'll feature another one of our markets. Ryan, thank you so much for being here and sharing your amazing expertise and real-time knowledge. Any last words from you, Ryan, as we're signing off?
I just have to say it's been great working not only with you guys, but all your clients over the years and all your future clients. I'm excited to meet more people and help them succeed in the Florida market. So thanks for the opportunity and having me tonight.
Awesome. Thank you so much. Guys, if there's anything we could do for you, please feel free to reach out. We've given you lots of ways to contact us. We're here for you, and excited to help you take your next steps. Steve, I'm going to give you the last word before we sign off.
I'm a man of few words, Kev, as you know, but just appreciate everybody being here tonight. Thanks for all that you guys did tonight to put this on. Thanks to all of you who came and participated. We just appreciate the opportunity to serve you. So everybody have a great night. Thank you.
All right, everybody. That's all we've got for you. I don't see any other questions. Thank you so much for coming. Thanks for showing up, and we'll talk to you guys real soon. Thanks. We'll see ya.